Welcome to Cambridge House Live. I'm Vanessa Collette here at the 11th Annual Silver Summit in Spokane, Washington. I'm joined by Scott Drever, President and Director of SilverCrest Mines. Welcome, Scott. Great to have you here with us.
Vanessa, thanks very much for having me. It's good to be back.
Scott, when we spoke in the spring, we were talking about the production ramp up at Santa Elena. How are things going since then?
They've gone very well. Our production is a heap leach open pit scenario at the moment. And as you know, we have a major capital expenditure going on to transition from the open pit heap leach into a conventional mill and underground. And that's going very, very well.
Well, that's great to hear. It looks like you've managed to keep your cash costs in line with your guidance. What's your 2013 guidance and how much of a challenge has it been to match it?
Our 13 guidance on production is for 30,000 ounces of gold and for 675,000 ounces of silver. Originally, at the start of last year, or the end of last year, we had projected 33,000 ounces of gold and I think it was 625 of silver. So we're down a little bit on the gold, up a little bit on the silver, and that's probably the way we'll end of the year. But it's gone very well to be able to predict a heap leach to that accuracy. I think is pretty good.
Absolutely. Given where silver is, are you generally happy with where your costs are?
Yeah, we are. Obviously, we grind on those costs all the time to keep them where they are, but I think our guidance was 825 for the year on a silver equivalent basis. And for the first half, we were just under that at 749. So costs are creeping up, you know. Operating costs, particularly cyanide, diesel, those things tend to keep on creeping on you. We're getting a little bit of a break in the open pit. The grades are going up, and our strip ratio is going down. So it offsets those cost increases.
I want to talk a little bit about La Jolla because you had some big news and just announced the preliminary economic assessment. Can we talk about that a little bit?
Sure. For those who perhaps are not familiar with the La Jolla project, it's in Durango State. We've been working on it for about 2 years now. We have a global resource there of 200 million, just under 200 million ounces of silver equivalent. That's silver, copper, and gold in that particular calculation. And depending what cutoff grade you look at, that's a 15-gram cutoff. If you go to a 60-gram cutoff, the metal content drops to about 100 million. So by multiplying the cutoff by 5, you only lose about 50% of the metal, which just goes to the continuity, consistency of the mineralization. The PEA, it's a huge deposit, and we haven't defined it as yet. And the initial reaction is, well, you put in a very, very large operation to make it work. However, large operations these days with the attendant capex of $1 billion, $2 billion, $6 billion are not particularly favorable. So with the PEA, we took a little different approach and said, okay, what sort of capital are we capable of dealing with in SilverCrest, and how can we ease into this like we did with Santa Elena? You know, we did a heap leach open pit that cost us $20 million, and now that is cash flowed $70 million, and that's almost paid for the mill that we're capitalizing at the moment. So we thought the same approach with La Jolla would be good. So we looked at a starter pit that we set some parameters that it would have to be less than 3-to-1 on a strip ratio, higher grade, obviously, and keep the capital down. So we came out with a starter pit that gives us about 9 years life. The capex is 141 million, and it gave us a rate of return, I think, of an IRR of 30%, just a little over 30%. So at this stage in a project like that, those are good numbers. And we should be able to handle that capital. You know, that's 2 years, 3 years down the road. Santa Elena will be doing 4 million ounces of silver equivalent. And if the metal prices cooperate with us and we can get $30 an ounce, then we'll be cash flowing $60 to $80 million out of Santa Elena. So those all fit very nicely.
And specifically with La Jolla, what's your development timeline there?
Our next step of it will be a pre-feasibility study.
Okay.
So in order to do that, we'll have to upgrade our resources from inferred to indicated. That will probably take us the back half of this year, pre-fees early next year. And often we do our studies to a higher level. You know, we can't identify it as that, but we have a higher level of confidence in our pre-feases than most people have in their feasibility studies. So we would probably kick off on the basis of that and start our construction at the end of end of 2015, shooting for production sometime late 16 or early 17.
And are you planning on upgrading the resource there?
Yes, obviously we'll upgrade it to cover off the pre-fees, and we haven't cut off the deposit itself. And there are 3 satellite deposits there that are probably mineable in and of themselves, which we need to further define.
Well, you mentioned that costs have been mostly going up. I'm just curious, are any of the input costs actually going down at all?
We don't see it at the operating level, no.
Okay.
On the CapEx side, it's not unlike when we put Santa Elena into production, or we're looking for financings and things in 2009, 2010. It was an economic disaster, but that meant your CapEx for your machinery, plastic, fittings, contractors, all of that stuff came down. And we're seeing that here again in the CapEx at Santa Elena that we're going, that the operating costs pretty much continue to grind upwards, but the CapEx numbers are coming down.
Going back to the PEA, you used some somewhat conservative numbers in there. Do you think you were playing it safe, or is that just the standard these days?
We don't have a lot of control. That study is independent in that the QPs are independent, and they, as individuals and as part of their company policy, they will pick their long-term metal prices. And you can disagree with them as much as you like, but that's what they use. So it doesn't hurt to be a little bit conservative, particularly at this stage.
Mm-hmm. Scott, how have you found the market reacting to your news lately? Have you been able to see any traction?
Straight answer, no. We get valued on our cash flow and our current cash flow from the heap leach operation. I think we get valued on that basis. There is very, very little that I can see in the value of SilverCrest overall for our increased production, which will go up probably 50% next year in terms of metal production. We get little value for that, and we get very little value for La Jolla.
Now, you secured a $40 million credit facility earlier this year. Was that a challenge, and how important has that been for you?
Compared to our financings that we did in 2009 for the production unit, it was no challenge at all. Because we're so profitable and our cash flow is very good even at these prices, we had a lot of people making proposals to us for financing. And we took the approach that we wanted to get the cheapest money that we could, and we didn't want any bells and whistles, which a lot of the groups that come in, they want warrants, they want a hedge position and those things. So for Scotia to come along and work with us on that basis, we have a straight plain Jane $40 million revolving line of credit that has LIBOR plus 3 and the usual banking fees. So we were really happy to get that. What that does is allow me to sleep much better at night. We have a CapEx budget this year of $66 million. and we're about 75% through that. We're still cash flowing about $2 to $2.5 million a month. We still have $20 million in the treasury, and we haven't drawn down the line of credit at all yet. So I sleep much better.
Oh, that's certainly a good thing to have in these kinds of market conditions. A lot of people these days are saying that SilverCrest has moved into a mid-tier producer. How accurate do you think that is a reflection of the company?
Well, certainly, I think that label should stick once we have the mill up and running. That'll take our production up to about 4 million ounces of silver equivalent, and that's pretty close to mid-tier.
Right. Excellent. Well, what are some of the exciting things we can expect from the company in the next 12 months or so?
I think the fact that we continue to make money at these prices is really good. I expect prices to improve over the next 6 to 12 months, so that just amplifies that, I think. The mill being completed in January and turned on and get the bugs worked out of it will be a big movement, I think, for a big milestone for us. And because people are waiting to see, can they finance, can they construct, can they execute? So if we can get those three questions out of the road by mid-next year, we'll have some exciting times in terms of cash flow improvement and how we've stepped into that position.
Great.
On the exploration development side, the Santa Elena mine is not defined. We're open laterally, we're open to depth, we're discovering new zones all the time within within that main zone area. We have 2 new zones lying beneath the main zone, the Chalugo and El Chalugo Dos, and we have some cross structures that are turning up and getting bigger and bigger as we go down. So there'll be lots of exploration excitement there. We're looking at acquisition of projects in the immediate area, and I find it extremely exciting that our research in, say, a 60-kilometer area of Santa Elena is turning up things that could look like or do look like Santa Elena, in the context that Santa Elena sat there, very visible, from 1915 until we picked up in 205. Right. And so it just takes somebody to recognize the value and then be able to execute on surfacing that value. And so I think you'll see some exciting news on those types of acquisitions for us.
Great. Well, it was a pleasure having you with us here today, Scott, and look forward to chatting with you again soon.
Vanessa, it's always my pleasure.
Thank you.